And we are back to standstill after a blistering day in the markets in the wake of April's US CPI data. And today we're going to try to sift through what has happened and what is possibly coming to spoil the party next, though it is a party nevertheless. This is Macro Money. I'm Ilya Spivak, head of global macro here at Tasty Live. And we're going to unpack this a little bit and see whether this is, in fact, the restart of the first quarter, everything is peachy rally, or if, in fact, there is something that's a little bit missing this time around and what that might mean going forward. So let's first take a look at the response to yesterday's US CPI report. It of course, came in exactly in line with expectations. 3.6% on the core figure was perhaps the most emphatic part of the story because it restarted disinflation in the area that the Fed is most concerned about, the core services part of the economy. That's where inflation has been stuck. That's been what's bedeviled the Fed's efforts. And we saw that begin to once again march to the Fed's drumbeat in this release. That part of the story contributing 3.1% to the overall number, which was a difference of just about 20 basis points for the decline. So certainly an encouraging sign, about 0.2 percentage points of a decrease in that component, which gave us the lowest core inflation in 3 years. Not surprisingly, we can see here the markets loved it. Stocks were up strong, over 1% on both the S&P and the NASDAQ. Yields were down, and although crude oil is still kind of marching to the beat of its own drum and doing very little of anything, gold was up, dollar was down. This is a proxy here for the overall direction of the dollar vis-a-vis the euro, its most liquid counterpart. The yen was down, interestingly, but it continues to jostle around and do its own thing as well. You might expect that typically if yields are falling, the yen would go higher, but that was not the case. And the very strong, very emphatic signal of buoyant risk appetite, Bitcoin obviously having a splendid day. So all in all, this is fairly unmistakable. So S&P up, NASDAQ up, yields down, gold up, dollar down. This was a story about the market cheering for Fed rate cuts. This was the market saying, after months of inflation surprising on the upside, the Fed has the inputs it needs. It was right not to panic. It was right not to over tighten in the face of the speed bump that we saw in the early months of this year. We're going to see cuts. And so what you see here, this is a chart that you'll be familiar with if you've been watching Macro Money for any amount of time recently. We come back to it over and over again. In the gray is the stock of rate cuts being baked into Fed funds futures for this year. In the blue, the S&P 500. In the green, the Fed's own forecast for how many times it's going to cut this year that it established in December of last year and reinstituted in March. So what are we looking at here? We can see that as the stock of rate cuts was diminishing, it was okay for stocks while there were still more cuts than the Fed expected. Once they equalized, stocks stopped rallying. Once the markets moved to a more hawkish setting than the Fed, stocks fell. We appear to have established a kind of new normal, right at about where we are currently. At 36 basis points, we're baking in one cut and about a 50-50 shot at a second one before the end of the year. What this CPI data seems to have done in coming in line with expectations is said, yes, this is correct. What you've already baked in has not been dislodged here. We are accurately priced in markets. Risk on, go ahead. There's no further risk that we go to, let's say, no cuts as a consequence of CPI, or maybe we even have to ponder the idea of a hike. No, that's not what's being telegraphed here. So the market's not surprisingly cheer, and the response is as we've just seen it. The tempting thing to say is that we are back to what is essentially the playbook from the first quarter. Now, in the period that starts this rally in the fourth quarter, what we see is rate cut expectations building out. And so you get an upswell in stocks because you have this initial move to say the Fed is done with tightening. That much makes sense. So we can see once we sort of stall here, so do stocks until we begin the new year and a kind of new logic takes hold. So we can see that even as the overall stocks of cuts is diminishing, stocks are still able to rally, and that's because they appear to be rising for the right reasons, and the cuts appear to be fading for the right reasons. It's not until we get to a more restrictive setting than the Fed that things get a little bit more spooky. But what are those right reasons? Well, here's the Citigroup U.S. Economic Surprise Index. And what you see here is that in the first quarter, this is this right here, U.S. economic data is becoming better than expected. And so, yes, we're shedding cuts, but we're shedding cuts because the economy is strong. Well, the playbook now has to be different because this is not what the economy is doing. Very clearly, we can see here, we're looking at U.S. economic data that is very rapidly deteriorating relative to expectations. Not only, as a matter of fact, is it rapidly deteriorating directionally, like, for example, here, where the data is surprising to the upside with a diminishing degree, but it's still in positive territory. The index is above zero. So we're still tending toward positive surprises, just less so over time until things equalize by around the start of the year. We're below zero now. We are in a place where data is actually tending to miss relative to forecasts, which means that whatever the analyst community thinks the U.S. economy should be doing, reality is telling them that conditions are worse, not better. Not less better than they think, not less good, worse. And that's a meaningful difference. We haven't seen anything like this since the beginning of 2023. You can see it show up in all of the high frequency economic growth indicators. Here's the latest round of the purchasing manager indexes from S&P Global. We can see here the April numbers were shockingly weaker than expected. And clearly something of a downturn is taking shape here over recent months. And as ominous as this looks, the ISM data set for the same period is scarier still. April was actually the first month since December of 2022 that both the service sector and the manufacturing sector saw economic activity contract. As ever, of course, this is in the logic of PMIs, so 50 is the center line, above 50 is growth, below 50 is contraction. The further you go in each direction, the faster the momentum. So above 50 and higher is faster growth, above 50 or below 50 rather, and lower is faster contraction. What we see here is that we're below 50 on both of these for the first time since back here. And that, of course, should be very ominous. Now, we did get a brief dip here, which is what I mean when I say that December of 2022 is the last time that both of these were negative, and maybe we'll bounce here again as we did here. Or maybe we're looking at the start of something that is a lot more worrying, and we are in finally that part of the cycle where there is a blistering rise in interest rates that catches up and growth actually starts to turn. And this is where we start to have a conversation about worrying what you wish for, being careful what you wish for. Because if the markets are so emphatically cheering that CPI has continued to disinflate, what they're cheering for is the Fed saying, we don't need to hike again. We don't think that there is a lasting reacceleration. We heard this from the Fed in March. They were asked, well, how did you keep 3 cuts in the forecast when you're upgrading growth and inflation forecasts? And Jay Powell, the Fed chair, said, well, the upgrades reflect data that's already out, as if to say, we see this data getting worse in the months ahead. We see disinflation restarting because the economy is going to turn in the months ahead. What have we seen since? Disappointing economic data, including in the labor market. That NFP report that everybody got so happy about showed less hiring and a higher unemployment rate, the very thing the Fed's been looking to see, and the reason that they think that they're going to need to cut. The global economy is basically composed of 4 large pieces. About 50% of it is 3 major economies: the US, the Eurozone, and China. The rest are vendors to the former 3 for the most part. Think Canada or Mexico in the US. Think all of Central Europe, Nordic Europe, in the case of the Eurozone, the UK as well. Think Australia, Southeast Asia, a good amount of Latin America and Africa for China. And so while it looks like they're only 50%, which is of course huge already, they're actually even more impactful. So what happens in this framework if the US really is finally starting to feel the weight of all those rate hikes? If all of the fiscal stimulus that we saw from COVID times is finally running dry, well, it might be starting to get a little worrying here. We can see that if we average the composite PMIs, so that's services and manufacturing, for these top 3 economies, this is the first time since back here, going all the way back to early 2023, that their cumulative average has showed slowing. Now, it hasn't shown up yet in the composite JP Morgan global PMI survey, which is adjusted for weights and adjusted for their relative contributions, and obviously includes more than just these 3 economies. But if this episode is at all instructive, we can see that there's a bit of a lag here. You can have this index roll later than the top three. And of course, that makes perfect sense. If these economies are vendors and these economies are where end demand lives, it would make sense that end demand would start to weaken first and the vendors would feel the knock-on effects later. You don't set contracts today for things you're going to sell today. There's a lag. There's a period between which existing business orders need to get worked through, what in nerdy economics circles is called menu costs. This takes time. And so it would make sense that the vendors would feel the pain after initial demand has started to weaken, because it would take time for existing business agreements to get worked out, work their way through, and then for the new ones, once those agreements are re-upped, to show that things are starting to weaken. So we can see here there's about a 2-month lag when this appeared last time. Nothing is to say that we don't necessarily have something here again, but that these three economies that really constitute the engine of global growth are starting to now weaken on average together. That's not good news. We can see here, as a matter of fact, that if we look at the way that U.S. economic data has been deteriorating, this is that same surprise index, and then we look at the global one has started to slip as well. Now, it's not quite below zero the way the U.S. one is, but they appear to have rolled over in tandem. And so as the markets cheer, the question is, well, is this really just a Pyrrhic victory? What exactly are you cheering? If in the first quarter you were cheering cheaper credit and the global economy was growing, so you had a Goldilocks environment, that growth part of it is loudly missing this time. Now, this is not to say that stocks should fall tomorrow. To once again quote the great Ira Harris, if you're right at the wrong time, you're wrong. So markets are not showing their response to this at this point. But the atmospherics are very plainly different than what we saw in the fourth quarter or in the first one. And this brings us to the economic data in front of us now. We're about to get, over the course of the next 24 hours, industrial production and retail sales out of China. We can see, as we looked at moments ago, this is, first of all, the world's second largest economy, and second of all, a major growth engine. And the expectation is that in April, we're going to get some tepid improvement in both industrial production and retail sales, which would give us some happy vibes about both the external growth engine in China, the export-led piece, as well as domestic demand. However, that surprise index has been going the wrong way for a month. And what we see here is risk of disappointment. If this ends up giving us data that misses relative to forecasts, well, then the conversation is going to start to be, well, so if the U.S. is slowing, who exactly is supposed to offset it? Especially considering that China, though it is one of the three major engines, is still mainly an export-dependent economy. It still fundamentally needs its role as the global value-add hub to sustain growth. We can see that in spades looking at Chinese manufacturing and service sector PMIs, which, by the way, have already started to turn lower after a recent upswing, but have really struggled to do much of anything since reopening after COVID restrictions. We can see here, there's 50 after an initial pop with service sector activity surging once the reopening kind of lets everybody out of lockdown and there's a big wave of spending in its wake. things have basically settled to near standstill. And that's because what China still needs to sustain growth is export demand. But that's very difficult to do when you've been in lockdown longer than your main customers in Europe and in the US, which have taken the excuse of you being locked down to say, you know what, geopolitically, this has been a little testy lately. The population in China, by their own admission, is starting to shrink. So maybe it's not as good of a value add hub proposition as it was 10 years ago. And they're closed for COVID while we're trying to reopen. Let's diversify. And so, on average, China has lost about 3% of cumulative global export and import flows as a consequence of this. So, when you look at this situation in China and you say, okay, well, if the US is slowing, are they going to offset? Is global growth going to find a backup engine there? Probably not. You do have Europe, and that is improving, but Europe was shrinking for 9 months until March. It's only cautiously returned to growth March and April, which tells you that there's probably not a strong hand there either. It'll take a long time to get back to anything that can offset a US downturn. And then the question really is, should we be cheering? Because if rate cuts are coming because the global business cycle is unraveling, that's not good news for earnings. It's not good news for stocks at all. But of course, until the price action reveals as much, we'll have to watch and see. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what may follow thereafter. I'm back on for Futures Power Hour tomorrow, on with Victor and Tom for First Call on Sundays. Back on with Victor for The Price of Truth on Wednesdays, writing for the News and Insights portion of tastylive.com, and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for joining. See you for Futures Power Hour tomorrow.